You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome back to another episode of The Builder's Mindset. It's, earnings season is essentially done, but there's still lots of articles coming out. And this is one of my favorite times of year, 4 times a year, because we get to do it every quarter. And last week, we had a really long episode. Apologize, not in advance, because hopefully you've already listened to it. You probably had to listen to it halfway to work or halfway on the way home from work, unless you live in Southern California. Then it was probably just perfect timing for your commute. It was a little over 45 minutes, but I did probably the deepest dive that I've done into the public home builders, their margins, and their overall performance. We did a quick market summary where we talked about affordability constraints intensifying, margin and incentives being sticky, rising SG&A, sales, general, and administrative expenses, really just sort of like continuing to put pressure on margins, and capital allocation, like builders, stock buybacks and how those are continuing. And so, we dove into some of where the strong performances were and where the weak performances were. So what we're going to do this week is something a little bit different. And one of them is probably a bit of a recap, except we were waiting for Builder Magazine and Zonda to do their launch of the Builder 100, and we had the data because we pulled, at least for the publics, we had the data because we pulled it off of their financial reports that they have to file. But we wanted to wait for that to come out and then just reassess and revalidate. I'll tell you in advance, we're not going to dive too much into Seki Sui because of what they were pre kind of the two companies in post. We'll figure out how to deal with them next year, this quarter. I'm still struggling to figure out how to convert their stuff into American dollars. But anyway, so what we're going to do is we're going to do a quick summary of where the builders did from a closings perspective, and I'm going to look at it 2023 to 2024. I have the 2022 data, so if anybody wants to look at that, there are some notables that I might touch on, and we've got this prepared and ready to go out to our community. So if you're interested, sign up for our email list. You'll get the public home builder closing overview that compares 23 to 22 and 24 to 23. And without further ado, I'm going to jump right in. And I think what's interesting is one of the things that Zonda reported in their follow-up to their Builder 100 is that Lennar, with over 80,000 closings, is closing the gap and now leads starts in 7 of 8 U.S. regions. Their superior future lot pipeline positions them to challenge Horton in the near future. Zonda, I love you guys. And what have I been saying probably for the better part of 12 months now? That I believe, and I've gone on record as saying that by 2030, I believe that Lennar is going to take over Horton for the number one builder as it relates to closings. And we'll dive a little bit into that right now. So let's jump in. So I'm in line with Zonda. Zonda's in line with they're validating, like, actually, if I were the bookie and I had odds, they just kind of like, I guess, since I'm the house betting on Lennar, my odds just got better if you're betting against Lennar. So I don't know. So anyway, so Zonda and I are on the same page with that. We do feel like, I'll go on record as saying that's my bet. I think that's what's going to happen. And Zonda just makes they bring a little bit depth to too by saying that they lead starts in 7 of 8 U.S. regions, and superior future lot pipeline positions them to challenge Horton in their future. They probably got a little bit more riding on their, the forecasts that they put out and the numbers, but I'll roll the dice and I'm going to say they're going to be there 2030, and that's for closings in 2030. So we won't find out, till the end of 2030 if they do that or not, but I believe that's going to happen. So let's go. Let's jump into it. So here's what we're going to do. I'm going to hit it up, and we're going to start off with who were the biggest and the lowest performers when it came to change in closings from 24 to 23. Just in terms of total sheer number, yep, you guessed it. We were just talking about them. Lennar. Lennar had 7,123 more closings in 2024 versus 2023 for a gain of 9.75%. When we look at it on a percentage basis, though, Land C Homes with their 708 additional closings, incrementally. So their 2024 closings of 2831 was 708 more than the 23 closings of 2123. That was a 33.35% increase in closings. I think there's some validity there from the standpoint of why they looked attractive to the new home company and that recent acquisition that we talked about. And so that was a couple weeks ago podcast. And so anyway, so that's where there is some other note. Now we'll just down to the bottom. So from a sheer number perspective, LGI had 598 less closings in 2024 versus their number of closings in 2023. Affordability has really hit them. They are about, I would say they are the entry-level buyer. I think, that is their target group. You've got other folks like Horton Express and Meritage and Century Complete, but I think LGI sets the bar for the entry-level buyer, and that market is really strained with just affordability, mortgage rates, and that came through as we talked about last week in their SG&A expenses and how that translated to their net margins. So their gross margins are still solid, but their net margins are taking a big hit on what they've got to do to move home. So 598 less. That is a reduction percentage-wise of 8.89% year over year. And then when we look at they're the lowest performer on a percentage basis too, because nobody else decreased in their number of closings. We had some that were really, really close. And some of the other notables, we won't go over all of them. Like I said, sign up for the community. You'll get on the mailing list, and we'll share this overview, which has 24, 23, 22, and the deltas between them both in number and in percentage. Happy to share it with all of you. But some of the other quick notables that we'll go over are is DR Horton. And this kind of plays into what I've been saying and what Zonda sort of reiterated a little bit is Horton, their closings changed. They were up 2,534 or 2.79%. So that's where, Lennar made some significant ground this year. If you look at it, say, in the 2023 closings, Lennar was 17,690 closings behind DR Horton. In 2024, they were 13,100 closings behind. So they're gaining ground. They're making some ground there. And Horton just had a little bit of a slower comparatively, 2.79%, which to be honest, short of LGI, that was the smallest percentage growth. Now, I don't want to make light of that in the sense that they talk about it as like if you're Coca-Cola or you're Toyota, you are the leader. It becomes very difficult to both maintain that number one position and grow your top line revenue. You're just already so big. So don't want to make a huge deal about it, but do want to say other than LGI, they were the lowest percentage in terms of increase closings year over year. And from an absolute value number, Pulte Group had 2,616 more closings. So from an absolute value, they beat them in terms of number of closing improved year over year. Some of the other notables we had was Meritage Homes was 1635 up 11.7%. Taylor Morrison an increase of 1401 up 12.19%. Century Communities up 15%. Dream Finders 1269 which was 17.35%. Watch out for them. We'll talk about their metrics on the next slide when we get into the next topic here in a second. Tri Point Homes, increase of 1186, 22.49% increase in closings year over year. And then it was the same thing. When you go to the smaller builders, newer startups, and this is for any industry, it's a little easier to grow your business both in sheer number as well as margin, or sorry, as well as a percentage. It's just, you can fly under the radar. It's easier to grow a little bit of market position when you're the smaller guy. And so when you look at, so we got Green Brick Partners, 21% increase, Smith Douglas almost 21% increase, and as we mentioned, Land C, a 33% increase. So that's the closings numbers year over year, and we are, we're looking forward to seeing what everybody does, and we've made that big prediction for this year. We believe, and I'm not going to give data per se, or I'm not going to make predictions builder by builder, except to say that I believe we're going to be within plus or minus 2.5% when we tally up. And I went a little further last episode. I think when we tally up the publics, plus or minus 2.5%. I believe when we tally up the top 100, I think we're still going to be plus or minus 2.5%. That one's a little more nervous for me. If I'm a betting guy, I'd feel better at plus or minus 5. But we'll go plus or minus 2% on the public builders change year over year, and we'll go plus or minus 2% the top 100 builders year over year. So, without further ado, we're going to jump in now. What we wanted to talk about is really, this episode is about the margins, right? Because what we're hearing right now is a lot of gloom and doom. We're hearing that selling season is done, it's dead, going to be a horrible year. I've gone on record as saying, I believe if you look at March numbers, things have kind of come back a little bit and they're settling down. And I've said, I don't think we're looking at a massive year, but I am still going to hold my judgment for the year as a whole until I see April, May, and June. I want to see Q2 numbers because I believe it's just delayed this year. I still feel that, like I said, if I'm telling you I think closing is going to be plus or minus 2.5%, I'm not saying that I believe that 2025 is going to be this rebound record year, but I don't think it's going to be the valley of doom. And so with that, I wanted to look at really, and this is what the analysts look at, and I thought I would jump in really quick and kind of give you, and we'll make this available too, once again, if you sign up. This will take us a little bit more time, so I think within the next week we can give you the closing comparison, and then here we're going to talk real quick about gross margin, revenue, and closings Q1 of 2025 versus Q1 of 2024. So we can kind of really get a picture of what normally happens. As we've always talked about, the buildings, it's seasonal, and so you tend to kind of get sales coming back, but generally revenue tends to be a little softer in Q1, and margin should be compared to others, but when you look year over year, this is going to help paint us a picture. So let's jump right in. Let's talk about gross margin, because there's lots of gloom and doom about that. The home builder stocks have been taking a beating. I haven't looked at them in a couple days because I'm not like a market watch guy day by day, but what we're gonna jump in and we're gonna say is anybody who was flat to positive, we're going to highlight them, and then anybody that was down 2% or more, and then everybody else, if I don't mention them, they were kind of somewhere down between, down, 0.1% to 2%. So who are the big winners? Let's just start there. The big winner, the biggest winner, Dream Finders Homes. And I just mentioned them before because they had such an incredible amount of growth in their closings. They had a 17.35% growth in their closings from 2023 to 2024. So let's see what they can pull off in 25. I went on record last week, I think, as saying, not my niche business model, what they do. They're a little bit more of a personalized builder. I wouldn't call it custom, but it is definitely not entry level, not spec home build. So really not my forte per se operationally, but I'd say I've always had a respect for Dream Finders. They're very entrepreneurial. They've grown leaps and bounds in a short window of time, and they're executing really well. And, their Q1 gross margins of 27.8% were 1.5% higher than their Q1 of 2024 margins of 26.3. So they're the big winner in my opinion. So their closings are growing. They're doing acquisitions. They're doing some really good stuff. Also, I believe on their mortgage front with their partner mortgage company, and their gross margins are showing it. So also in that positive area, Tri Pointe Homes, they're up 0.9%. Q1 2025 over Q1 2024 at 27.3%. Another stalwart of like solid margins in the team over there at Tri Pointe. And then last but definitely not least, because they also their closings 24 over 23 were up 12.19%. Taylor Morrison maintained even margins at 24% Q1 2025 versus Q1 2024. And look, I'm not a gloom and doom guy, but I will say that all of that's good stuff. That is running your business well, executing on your plan. Taylor Morrison has they're reasonably protective of their margins. They do a good balance of price and pace, but they're really good about being disciplined about the markets they buy land in. They have some entry-level plays here or there, but they definitely try to stay in sort of more of those B and A markets. I would say, they try to be very strategic in the entry level and be in that B, kind of B minus market, try to shy away from the C markets. And I think that's really helped them out, helped them maintain their margins. And I think they've got a lot of operational discipline that they've been implementing to do that as well. All right, so that's it. We had 3 builders who either maintain margins or grow them. So that means all of the rest of them, when we look at the rest that we look at, that we talk about, is that we have a lot of negatives. So and this is from the guy who's not too typically gloom and doom. So when we look at that, where do we go? We'll just kind of run through some of the ones that I feel like are in the norm. I think if you're down 1% or 2%, 2.5%, that's pretty much what the market's given everybody right now. So we've got NVR down 2.6%, Pulte down 2.1%, and then we start to jump up a little bit, and we've got Lennar down 3.1%. Here's what's interesting about Lennar being down 3.1%, and they got hammered. But if you go back and listen to the earnings call, man, they take it in stride. They have a plan, they have a strategy, and they're not going to be knocked off of that. So they're still 18.7 gross margin. And if you go and look at their net margin, which let me jump into that really quickly, and I can tell you where that is. Hang on. Thought I had their net pulled up. All right, I'll have to get that up for us later, but we'll see if we can get that. So 18.7 gross margin, not horrible. Their net was still reasonably solid. And here, we are just gonna go right there. We're gonna go. So Lennar's net margin after tax, 7.26. We said that's kind of pushing things a little bit, but they've made some serious investments. They had the Roush Coleman acquisition, and they also invested a lot of money in their software for the Rock. So that's going to take a little bit of a ding on them. So let's go back to the numbers. So at 3.1% where they got hammered, though, let's talk about that now. So we also, though, had Meritage Homes down 3.8%, but still a solid 22% gross margin, with that 3.8. And I believe Meritage has a bit more exposure to that sort of entry level than Lennar does. Lennar, in some of their markets, they play a little bit higher price. Southern California, they're in Orange County, definitely not an entry level market. Toll Brothers down 3.9%. Interesting, because Toll's a completely different end of the spectrum when it comes to the buyer demographic and price point. But, they're really just having to do some significant incentives to really get things going for them from that perspective. And if we go look at why are we there we are. I am having some problems today with my tabs being open. Okay, so Toll, we'll go back to Toll. So where Toll was from Q4. So Toll, their SG&A is 13.1%. We always talk about like 10. 10's kind of the sweet spot, or 10 or under. But like I said, I'm gonna shift that to 12 for this year, because I know incentives are gonna be sticking high. Meritage was up at 11.3. And so that's really what's gonna be driving a lot of this, I think. Sort of the gross margin is going to come from they're just getting competitive on pricing and being strategic about their pricing, and then the SG&A is going to be hitting their net. So okay, so also on the negative side, KHOV. So another tough one is that KHOV is down 3.5%. So they're down to 18.3%. So their margins are lower than Lennar's now from a gross perspective. And it's tough. I mean, they're a good size builder, but they're not massive. They definitely don't have the same scale that the top 5 or 6 or 7 builders do. And so we're just gonna have to see, how they weather that storm, going through, getting through 2025, which a lot of people are saying survive 2025. And what was the one I heard? I think, there was something, Burns had a good one for 26, and I forget if it was their quote or something they quoted for somebody. There's just get to 2026 and things are gonna change. So, and then also Beazer, like the one of the big ones, down 4.6%, down to 18.3% gross margin. So, really took them down to the level of KHOV as well. And so they're going to be really kind of struggling, if they could stay in that place, if they can stay at that 18.6 and, maintain, their net income, they've got some other things on their books. I believe that they're working through. Their net income is 2.3%. KHOV was 3.3%, whereas Lennar 7.26. Just Lennar's a little bit better capitalized, a little bit better leverage and volume, but we'll just have to see how 2025 goes. And how they come out of it. And like I said, I'm not going to I'm not giving out, let's phrase it. I'm not taking away any awards from anybody for what they do in 2025. You make it to 2026, you get an award just for that. So, all right, let's jump into the revenue to see what the little bit different picture there. So we look at revenue. We had 1, 2, 3, 4, 5, 6, 7, 8, 9 builders, 9 public builders who still managed to increase their revenue year over year. So Lennar up $700 million, NVR up $60 million, Taylor Morrison up $190 million, Dreamfinders we talked about up $140 million, KHOV up $50 million. Beazer up $180 million. So there's a bright spot. So Beazer is, kind of increasing in their revenue. So which that could help them out as they try to weather the storm. Green Brick up $50 million. Smith Douglas up $40 million, and Land C up $190 million. So another bright spot we talked about. Maybe why there's some things. So Land C has increasing revenue, and their closings were up year over year. So they're in a solid position now. On the other end of the spectrum, what we have is we look at, Horton's revenue was, down $100 million. They're just lowering prices and not getting as many closings. Pulte Group down $120 million. Meritage down $130 million. MI Homes down $110 million, and TriPoint down $200 million. So interesting to see what's happening. Like I said, it's 2025. What I take away from this is none of these were huge numbers. None of these were like really, really massive, even on the revenue perspective. So I think you've got some price. And so this is where I think builders really get to work on that price and pace and profitability thing to see how things shake out for them. We know very well what Lennar will do. We know what Pulte will do. It's kind of interesting when you talk to those, like a tale of two different cities, right? Lennar's going to push their pace, and they believe they'll make up the margin down the road, even if that's next year. So they're going to keep driving forward in that perspective. Horton's going to try to balance, and Pulte, as we know, Pulte's going to try to maintain their margins. It's just it's in their DNA. It's in their pedigree. So now let's jump into closings, okay? So let's see. This is kind of where gloom and doom, because I don't know about you. There were a couple of negatives. Like I said, there were a couple of, kind of builders that were, if we look at it, there were 1, 2, 3, 4 builders that were 3% margin or lower. There were 2 builders that were 2% or lower. We even at the bright side, though, we had 3 builders who were flat or up. So let's look at how things are looking in terms of closings from Q1 2024 to Q1 2025. So Horton. Let's not start with them. We'll go to them later. So let's go to the strugglers, okay? Pulte, the big one is they're down 512 closings quarter over quarter, year over year. And then next would be Tri-Point Homes. They are down 353 closings on the quarter from 24 to 25. KB Homes down 267. And MI Homes down 182. Okay. There's some others that were negative, and we'll go 64. Like DR Horton's down 64. I'm not anything under 100. I'm not even going to really make a huge deal about. Of course, unless it's like down in one of the kind of the lower. You could make the argument that LGI was down 87 homes, quarter over quarter, and with their 996 closings from a percentage basis, it's probably one of the outliers, I would say, from that perspective. But generally, if it wasn't 100 or more delta, I didn't note it. So then we go to the positive side. I will mention on the positive side, less than 100 on the positive. I would say that Green Brick was up 89 closings, which same thing like the LGI. They had 910 closings. So to me, that was significant from a percent basis. But with that said, let's jump into the the kind of the other ones. So Land C, 105 closing improvement year over year on the Q. KHAV 191. So we talk about KHAV's revenues up and their closings are up. Yes, their margins are down, but like they're starting. I think they're feeling like they're operating. They're going to try to continue to move into that momentum and that volume, and it'll be interesting to watch them this year and see how they come out of this and get into 2026. Next is Dreamfinders. No surprise here, up 270 closings. That's a good clip for them with 1,925 closings in the quarter. Let's go Taylor Morrison, up 317 closings on 3,048 on there. I think their commitment is like 20,000 homes by 2030, I think is what theirs. So good for that. That's what they need. They need to keep pulling in. They need 10% plus closings each quarter and end year. Next is Beazer. 336 additional closings quarter over quarter. That's huge compared to their on their 1,079 closings. 743 in Q1 2024, 1,079 Q1 2025. So what's the next? Next will be Land C. Okay, we talked about Land C's got some things going on. 514 additional closings. At 505 closings in Q1 2024 and 1,019 in 2025. So really, really growing, kind of making some big moves there, and looking forward to seeing what they turn out this whole year. All right, then, no surprise. What do we talk about? And I think this plays right into the bet that I've made, right into what Zonda was alluding to, is that, yes, Lennar's margins were down, but they were down at the expense of their plan. And we talked about this. They play to their plan. 1,036 additional closings over last quarter. They had 16,798 Q1 2024, 17,834. Okay, so they're definitely not 10%, but still a solid improvement in a challenging market. So, that's kind of the highlights that I see. So to recap. So now what I'm going to do, I'll recap, is that I went through and I said, if you look at gross margin, you look at revenue, and you look at closings, who were kind of the big winners when you look overall? And from my perspective, I kind of gave KHAV a little bit of an honorable mention. Even though their margin was down 3.5%, they got their revenue up by 50 million, and they got their closings up by 191. The other big winners were Dreamfinders. We're talking about, watch them. They're on the rise. gross margin improvement of 1.5%, revenue improvement of 140 million, and closings improvement of 270. Look, if you're operating correctly, you can thrive in a challenging market. All right, and also Taylor Morrison, doing maintain margins, which is difficult at 24%, solid builder margins, solid player, at the position that they're at and the number of closings that they're doing. So maintaining their margins, $190 million in increase revenue, and 317 additional closings. So those are the two winners. I think when you look, at what's going on in the market from 24 to 25, Taylor Morrison and Dream Finders with an honorable mention to K-Hub. Now, when we look at the ones that are tough. I would say we're talking about, DR Horton, gross margin down 1.4%, revenue down 100 million, closings down 64. Not a really good way to start off the year. They're going to have to figure out a way to make that up on the back end, in my opinion. Pulte Group, same thing. Gross margins are down 2.1%, revenue's down 120 mil, and 512 closings off of last quarter. So that, once again, another big hole that they're going to have to dig out of. And then finally, LGI Homes. Gross margins are down 1.7%. We don't talk about really here, but we talk about their SG&A expenses are tough, high. Big incentives, big cancellations, and so their net margins are struggling. So gross margins down 1.7%, revenue down 40 million, and closings down 87 million. So everybody else, I would say, in my opinion, is kind of in the world of where they need to be from a fighting perspective. They might have one that I would call a negative, one that I'd call a positive. Even Beazer Homes, their margins were down 4.6%, but their revenue is up 180 million, and their closings were up 336. Land C, margins were down 1.9%, but their revenue is up 190 million. Closings were up 515. This is not gloom and doom, and I'll go back to what I said. There's a reason beyond the business strategy of why New Home Company purchased Land C and has taken them private. That goes beyond them trying to expand and grow their business to be a top 25 builder, which they will be now. And that for me is that they are bullish and believe in the housing market. There is inherent demand. It's just a little bit delayed. The millennials are delaying a little bit on their buy. The younger millennials are delaying a bit. The older Gen Zs are delaying a little bit, but it is coming. And those builders that prepare, get their operations right this year. Let's go, folks. You have... Well, geez, not a lot of time left because we are almost done with Q2. Calendar year Q2, we got a little over a month left, and then you got 6 months left to go. And here's where it gets tough. You're going to be scrambling for closings at some point in time in there, as we all know production builders do. Let's say between September, October, and November. So my advice to you, get a game plan in June. Execute that game plan in July and August, and be prepared in December, January to finalize and tweak those ticky-tacky things from an operational perspective. You could shift your land strategy a little bit now, but that won't come to play most likely until 2027 for you. But if you want to have improvements in 2026 when it comes to your cost, your margins, your performance, your lead time, you name it, buckle down now and start putting a plan of action. Assess your business. Pick your top 3 low-hanging fruit that you can go put a plan in place, execute that plan, task some people on your team to work with it, bring in a consultant if you needed to help you get it to the finish line or help you flush some ideas out. Because I will tell you this, if you don't get the right 3 and then you don't execute those right 3 well, you are going to miss the boat of what's coming in 26 and 27. You may be able to recoup for 27, but why waste time? Plan now, implement in the near future so you can execute next year. There's our summary. Like I said, sign up for our email list. We'll give you all this data for no charge. It's just an analysis. It gives you benchmarks to look at. What are the big publics doing? This information is all available. We just make it easy for you by spending, hours, crunching it and putting it in a format. We're nerds when it comes to the data that public home builders share. Our niche calls, we love it. We love talking about it. We love analyzing it. And so we hope you enjoyed this. We hope you enjoy the data. We look forward to seeing you. We appreciate your support. Talk to you next week. Until then, stay amazing. You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.